Good afternoon, everyone. I hope you can all hear me. So last week we started out equity market and equity market instruments. First, we went through what equity is. We went through what equity is and how it is different from debt. The basic differentiation factors that we saw between those two is both of them had two ways that the investor will get a cash inflow. If you take a debt instrument, what are the ways that an investor will have the cash inflow? First one is from the coupon payment. Second is from the repayment of the face value. If you take equity, the investor will get cash inflows. The first one through dividends, just like interest. When you hold a company's share and the company performs well, you will get part of their profits either annually and some level of a periodic return is the dividend that you receive. The second is the repayment of your investment at the time of sale. So when you trade your share, when I say trade, when you have bought a share and then subsequently you sell that share to someone else, you might sell the share at a higher price. It can be even a lower price, okay? But at the time of sale, you will get the sales proceeds. That is also a cash inflow to the investor. So in terms of income or a profit, then what he has invested in a share is the dividend and the capital gain. Capital gain is the difference between the amount that you invested when you bought the share and the amount that you got by selling that particular share. For example, if I bought the share at 20 rupees today and very next day, let's say on Friday, I bought it for 20 rupees and on Monday, I sell it for 25 rupees. I will get 5 rupees as my capital gain. I was able to gain an additional of 5 rupees per share I had. Okay. So that's a return or a profit or the additional income that the investor could get. Always equity is perceived or is viewed as one of the riskiest investment, especially in comparison to the bond or a fixed income instrument. Why is that? Because both the sources of cash inflows, dividend and even the sales proceeds is unpredictable or is not guaranteed for. Dividend can be paid by the company or the company can choose not to pay it as well. So there is an uncertainty involved in that. If you take sales proceeds at the time of sale, it can be higher than the price that you bought or it can be even less than the price that you bought. It could go either way. That uncertainty makes shares more riskier than debentures. Okay, and then we saw by owning a share, what does the shareholder get or what kind of a right does that shareholder get? First was the right of a residual claimant. What do you mean by residual claimant? You will get what is remaining when the company is dissolved or when the company is closed or wound up. Whatever that is remaining is entitled or is to be given to the shareholders. It could go again either way. There can be nothing remaining when the company is wound down after you pay your staff, your debtors, after you pay your creditors, your bank lenders, after you settle everyone else, you might not have anything at all. Okay? Or if your company was performing well, you established that company to achieve a certain goal, you achieve that goal. After that, now you're winding up that company. So when you wind up that company, you might have certain profits, certain high valuable assets left. So that can be shared among the remaining shareholders. So there is a possibility of maximizing wealth at that time as well. Next, we have the right to vote. That's a right to the shareholder. They could involve in the decision making of the company, and they can control how the company is functioning by using their votes. This is something that the lenders did not have. The lenders, now if you take someone like bankers or the debt holders, the ones who you borrowed money from through your debt sources by issuing debentures or by borrowing from a bank, those entities are unable to control an organization through vote. They can exert some kind of a control through governance, but voting is more direct control over the company. Okay. Then we saw why equity, even though equity is considered as one of the most costliest ways of financing, even for an investor, it's one of the riskiest ways of investment. Still, equity is the preferred source of financing. And we saw why. The major reason is equity, the source of finance, as using equity as a source of finance helps that company or gives that company room to take additional risk. Now we know higher the risk, higher the return. Okay. So as a business, think of yourself as an owner of a particular business. Okay. You are trying to put up an additional factory. That does involve a lot of risks. Okay. Operational risk, you might put up that factory in India. There's a country risk involved as well. So those kind of additional risk can be taken up by that company if they are sure that there is an additional return coming from that risk. Okay. Now, if they are using debt as a source of financing, okay, let's say they approach a bank, and from that bank they're taking a loan. That bank would ask so many questions. They would say, is this the first factory you're putting up? Do you have the capacity of accommodating that, having staff to run that factory? Do you have control or monitor on what that factory is doing? And they would be rather pessimistic on what you're doing, unless the company is very, very strong or established. Okay. If it's especially a new company which is still in the growing stage, it is considered a very high risk venture. We should agree on that. So lenders would be a bit scared. They might give you less money. They might impose certain covenants for you. Okay. But if you go for equity as a source of financing, what is the intention of a shareholder or an equity holder? They also want high profits. They know high risk, high profit. So for them to earn high profits, you or the business should earn high profits. So they would actually promote you to take calculated, it's not unwarranted or, unneeded risk. They would plan it out and would take the necessary additional risk to earn that additional return. Equity helps you or supports you in that way. And even on another benefit that you could see with equity is it doesn't choke the company up with any scheduled repayments or a mandatory requirement to repay the capital back. There is no any need like that. Therefore, the companies love to function on their own and is promoted or is encouraged to make higher profits. They are not compelled to pay out interest and they are not compelled to pay the capital out. So they could use their own funds and reinvest to grow the company. Okay. And therefore, due to this reason, equity is considered as one of the preferred sources of financing, especially when you are in the initial growth stages. Then you have the basic differences between equity and debt as a source of financing, tabulated, easy and summarized for you. And then finally, we looked at what stated capital was and what market capitalization is and how those two line items are different from each other. Then we moved into equity instruments. So equity instruments, what we are going to look at is we are going to start from the most conventional instrument and go to the more contemporary instrument. What do you mean by conventional? One of the most or the ancient type of an instrument that we look at, and then we go to the more modern instruments in the equity market. Okay, so one of the conventional instruments is the ordinary shares. Ordinary shares, if I buy an ordinary share of a company, I get absolute ownership and control over that company. Okay, be careful when I say the words. It is absolute ownership and control over the company. You are the owner of the company. So if you are the owner of the company, essentially, you will have the controlling power as well. Okay. So when you are the owner, your intention is to grow this business, earn profits, expand this business. Okay. So if you get a profit, you would want a part of that as your return because you worked for that company's growth. You have invested your capital to that company's growth. Okay. But if that company had a loss, again, would you pull out money from that loss-making company? You would say, no, let's hold on. Let's push through this company, maybe put additional capital to this company, try to turn around the company and take it forward. So as an owner, dividends that is paid out to you is is uncertain. You don't have a fixed dividend yield. It varies depending on the profitability of the company. If the company performs very well, let's say the profitability of the company doubled compared to last year, then you are entitled to a higher dividend. If the company made a huge loss, then you as an owner have to bear up. Okay. So as an owner, dividend as a form of return is uncertain for you. Okay. And then again, ordinary shareholders, we said they are the owners of a company. Therefore, they are the residual claimants. Why do I say residual claimants? When you wind up a company, you have a hierarchy in which you will pay out. Okay. Now, what happened? So in that hierarchy, how it works is, first you would pay your staff members. Okay, if there is any salary arrears for you. Better. Okay, so if you have any salary arrears for your employees, the company is required to pay the staff first. So staff payment or the employee payment is the first. I don't know why it's not coming in. So employee payment is the very first payment that you need to settle in your hierarchy. Then you have any taxes left. If you have not paid any taxes to the government, you need to settle that. Okay. Then you have to settle your now if the company is being closed down, there would be someone involved in winding up that company. So charges related to winding up that company has also been paid. Okay, and then you have senior or secured debt. When you say senior or secured debt, those two are two different terms. Secured is that particular debt instrument is secured against a particular asset. Let's say by pledging this table, I took 1,000 rupees. So that 1,000 has to get settled first before all my other loans. Why? That 1,000 has a specific asset for that. Okay, so I need to sell this asset and settle that. Okay, senior debt is the priority order. Now, if you take as a banker, I'm sure that you should be aware of it. When you give out loans, especially to the company, banks have a condition imposed in their offer letters. What do they say? The loan that you grant is not subordinated to the other commitments of the company or is treated as a senior debt, which means that company would have borrowed, let's say, from 5 banks. Okay, but moment you put that condition, you would become the priority, the first priority at the time of settlement. Why? It is the senior debt. Okay, and then fifth you would have the unsecured debt, and then finally you have any trade creditors that you need to settle for, and then very last then you might have the preference shareholders to settle. Let's say over here you will have the unsecured debt. Okay, and then very last one you will have your preference shareholders to settle. The very last is the ordinary shareholder. Okay, so they imagine if ordinary shareholder is the last person to settle. Okay, after you settle each one of them, and then you come to this person, you might sometimes you might not have anything at all. Okay, sometimes you might, the ordinary shareholder might have something more than what he has even invested. So risk could be, the possibility can go either way. Remember that. That's so as the residual claimant, ordinary shareholder faces larger risk than the others. Now, in ordinary shares, I told you, there is a term I used was the absolute ownership and control over the company. Now, ordinary shares can be split into two. Ordinary shares on their own or a standalone ordinary share gives you both ownership over the company and the control over the company. Okay, but sometimes the company can choose to split those two. Okay, they can choose to split it. How would they split it? They would have one category of ordinary share which gives you both ownership and control. But you might have another class of ordinary shares which gives you ownership, but you do not have control over the company. Now you will be confused, what is this? How can you have two types? Now, if you go to the Colombo Stock Exchange, let's go to one of the most used companies in our examples, Access Engineering. Okay. Now, how do I know whether this company's share is the ordinary share that is available or it's the preference share that is available? How do I know that? By using this ticker. Okay, the term ticker, I will explain it to you. Okay, it's like it's the stock symbol. This is the internationally used symbol. Now, this is to denote access engineering. Okay. So now, if you take this symbol, and if any company's symbols has this dot N followed by 4 zeros, it means it's an ordinary share. Ordinary share which gives you ownership and control over the company. In other words, it's a voting ordinary share. You have the right to vote and you are one of the owners of that company. Okay. But let's go to commercial bank. Yes. Again here in commercial bank, it's a .N stock, which means you are the owner. If you buy one share of this, you will become one of the owners to the bank. And then you also have the right to vote at their meetings. Okay, because you are one of the shareholders. But when you search for commercial, can you see here? You can see Commercial Bank of Ceylon twice. Why is that? Now there is another ticker here. There is one ticker finishing with .N. There is another ticker finishing with .X. Let's take both together. Okay. Now can you see that here it is .N, .X, and can you see that the share prices of these companies are different? One share has a higher price than the other. Now we saw .N is the voting ordinary share. You have the ownership and you have the voting. But .X means it's the non-voting share. This is the non-voting share of non-voting ordinary share of commercial bank. So here you have ownership, but do you have control over that company? Let's say you bought a non-voting share of commercial bank. You are one of the owners of commercial bank. But can you go to the share meeting and vote at the company's decision? No. You are unable to control how the bank works. That is why you can see one share which has both ownership and control has a higher share price than the share which only has ownership. Okay, this is important. So even in ordinary share, it can be split into two as voting and non-voting share. Now you will be wondering why do banks have or why do companies have these two shares? What's the point of having a share without any non-voting rights? Now, practically why that happens is this is more to promote foreign investors. Now, if you have foreign investors investing in our local market, you know that they are unable to attend share meetings. Okay. they are unable to control how the bank works. They don't have a direct control over the company. So most foreign investors prefer a non-voting share because no point of paying a higher price to that. Okay, so they would prefer a non-voting share available for them, and they would always go for a non-voting option when they invest. Okay, if you look at the shareholder list of several non-voting shares, you will see a lot of foreign funds, foreign investment banks coming in and investing. Okay, most of them confined to the non-voting category because of this. Then we have preference shares. Now I told you preference shares in the order of settlement. Preference share does get a preference over the ordinary shareholders. They were just above the ordinary shareholders. Can you remember? Okay, but they were below the debt holders. If there is any bank liabilities or debentures to be settled, those are settled first, and then you first get into the preference shareholders, and lastly to the ordinary shareholders. Okay, so preference shares from a legal perspective and from a tax perspective is viewed as a form of equity. Okay, why am I saying that? Because this share is a hybrid instrument. Hybrid instrument meaning it has features of a debt instrument and features of equity instruments. Now, again, remember, we are explaining this in the order of the conventional to the contemporary. Okay, so first, very basic was the ordinary, and then there were certain investors who preferred the features in a debt, in a bond or a fixed income security than the equity, and there were some equity features that they preferred as well. So they wanted a form of instrument which had both these features inculcated, like best of both the worlds. Okay, so what is best about debentures or fixed income security? Their return is certain, coupon payment is certain, repayment of the face value is certain, but that certainty is not there in shares. So when they are structured preference shares, they said at least let's have the dividend payment in a constant and a predetermined manner, so that that payment is certain. Whether the company makes profit or loss, you have to pay the dividend of the preference shareholder. Okay, it is constant. And now that means if I have to pay a constant dividend payment, from a company perspective, it is very, very costly for them. Why? If it's an ordinary shareholder and if they make a loss, they don't have to pay the dividend. But for preference shareholders, no, you can't do that. Whatever happens to the company, you are bound to pay the agreed dividend payment annually. Okay, and they required, the preference shareholders didn't really need any voting rights. They said we don't necessarily need to be owners of that company, might as well do not have that voting right. Why do we have to pay a higher price for that? Okay, and then they prefer to stay above the ordinary shareholders, because ordinary shareholders were the last to get settled at a winding up. Okay, so they are now preferred over the ordinary shareholders, but they are preferred lesser than the debt holders. They can't be equal to a debt holder, so they are just below the debt holder. Now these features you can see, even though I say this is as preference shares, These are the features of a debt instrument. Having a fixed or a constant dividend payment is very similar to having a fixed coupon rate. Okay. Having no voting rights over the company is very similar to a bond instrument. Having higher claims or more preferred claims over the company than the shareholder is another feature that you see in the fixed income security as well. Okay. But what are the features that they wanted similar to the equity is, now in equity, dividend payment is not tax, it's not a tax deductible expense, which means if the company pay the dividend, they cannot tell the tax authority, look here, the company incurred an expense, so from the profit, I am removing this dividend. They can't do that. Why? Tax authority will say, look here, you are paying to your shareholders. Okay. So before you pay to the shareholder, I need to tax this profit. Okay. So no, I can't let you deduct your dividend. Before you deduct your dividend, I need to tax this company. And after that, you could pay out your dividend. Okay. So dividend is not a tax deductible payment for the company. But if you take interest, not like that. Interest is tax deductible. Why? The company could always tell the tax authority, look here, to run the business, I had to borrow some money from the bank. Okay, so the company, the tax authority can't say, no, you are giving away the profit of that company to the bank. No, it's an expense that they need to pay. So the tax authority allows that payment. They will say, okay, you deduct that expense from the profit. After you deduct that expense, whatever remains, I will use it to calculate my tax. But for dividend payment, they don't allow. Why? The dividend payment is going to the owner, which means part of the profit which is not taxed is going to the owner. They would say, no. First, let's tax this profit. You're not allowed to deduct the dividend. Whatever that is available, I will tax first. After that, after tax profit, you can distribute. Okay. And due to this main feature, what happens? Preference share is highly costly than a debt instrument. Why? It has best of both the worlds. You as an investor would like it because you have a certain, you have a certainty in your dividend income. You have a priority over the ordinary shares at a settlement. Okay. So those are the additional preferred features to an investor. Okay. And due to this, it is considered as a hybrid instrument. And then you have convertible debt. Convertible debt is, in the beginning, it's in a form of a debt instrument, let's say debenture. For the first 5 years, you have issued as a debenture. On maturity, you give a right to the debenture holder, which says, if you want, you can ask for your investment amount back at the end of the debenture. We know at the end of the debenture, whatever that you invested has to be paid back. Okay. Interest you get annually. On maturity, repayment of the face value happens. So at that time, you will get the money that you invested in the debenture. Okay. Now, when that happens, that the investor has the option to either take the money from at maturity in that form, or they could subscribe to the ordinary shares of the company on maturity. So the investor, if I am the debt holder, I now have the option to either instantly take the money I invested in the debt instrument, or let's reinvest that amount in the shares of the company and get a higher return. Okay, that option is provided to the debt holder. Now, why is this considered as a low risk investment? because it provides the convertibility option to the investor. Now, let's see two scenarios. One scenario is on maturity, the stock market is performing very well. Now, you saw during September to January, our stock market was performing excellently. Now, don't even look at it. Why? Now it's declining, constantly declining. You could see the decline. So this is one quarter. Let's take 1 year. So you can see this was during the COVID period, and then subsequently you can see, let's say you invested on this date, your investment will grow, go to its peak. Okay, and then now it is having its downfall. Okay, let's say you have a debenture which matured on this date, let's say on this date, okay, or even on this date when the stock market is performing so well, you as the investor now has the option either to take the money out on maturity or reinvest in the share. Now, when you get that option, already the price would be described. You might have at the ongoing market price, or let's say 10% below the market price. That price at which you subscribe is already known to you. Let's say it's fixed at 20 rupees per share. Okay. Now, you know, in the market, your loan agreement or the document says you can subscribe to shares 20 rupees per share. Okay. And you know, in the stock market, this company's share is getting traded at 50 rupees. Okay. So why am I going to take the money out? If I take the money out, I have to buy this company's stock at 50 rupees in the market. I might as well convert it into equity, buy shares at 20 rupees, and then go to the market, sell it at 50 and get an even higher gain. Okay, that is a possibility to the investor. Or let's say the company is having a downfall somewhere around here. Okay, same option. It gives you the right to buy the share at 20 rupees each. Okay, but this company's shares at the moment is let's say 10 rupees. Would you want to subscribe for it? No. You would say, no, I don't want the share convertibility option. Just I would like to get my money back. Because of this, it is considered as one of the low risk investment. Okay, and it provides the investor a greater deal of flexibility because they have the opportunity to get a higher return. Okay, and remember, this is also a hybrid instrument, but a little bit different than preference shares. Why? In preference shares, it had both the features in the shares. In convertible debt, at the beginning, it is entirely 100% debt, but on maturity onwards, it could convert into equity. Okay. And then finally, you have depository receipts. Now, depository receipt is a very new word for, it can be new for you, but globally, it's one of the oldest equity instruments that is available. In Sri Lanka, it's very less. Okay. The use of depository receipt is very, very less. Now, again, imagine yourself as a business or as a company. Now, you are already listed in the stock exchange. What do you mean by listed in the stock exchange? Your company shares are available in the stock exchange to be traded. If I take this company is listed in the stock exchange. Why am I saying that? From the stock exchange, I can buy this company's shares, I can sell this company's shares. Okay, but let's say sometimes companies like Dumbro, they are not listed in the stock. I can't go directly and buy shares of Dumbro. It's not publicly traded. Or let's say another company. Now there's a new company coming in for IPO called Winforce. Okay, that company at the moment is unlisted. When they come for the initial public offering, after that they will be listed. But so far, I can't go and directly buy that company's shares. They will get listed in the stock exchange, and subsequently, I could go and buy that company's shares. Okay, that's what I mean. So imagine yourself as one of the listed companies. You're already there in the stock exchange, but you would want to get some international recognition. You would want the investors abroad to know, oh my God, there's a company like this in Sri Lanka performing so well. Okay, and you would want your shareholders to come from different backgrounds. Now, when our shareholders are from different backgrounds, remember, shareholders have voting rights. So their input is essential in running the company as well. So you would want to diversify your shareholder base, or you would want to improve the company's profile with the foreign investors. Okay, and you would want to make your shares be available to be traded internationally. Okay, those are usually businesses that when they reach a certain point, those are certain things that they would prefer to get an edge over their competitors. But think from the point of an investor. Okay, think one of you is an investor and you want to invest, let's say, for example, in a Taiwan company. Or let's say a Myanmar company. You know what's happening in Myanmar at the moment. So let's say you want to invest in a Myanmar company. Okay. First issue that you would have is you will have exchange controls. How you are going to invest, how much of money you can route. Okay. There'll be so many regulations. Okay. And then you as a shareholder, you are here. The shares you have bought, or the company's shares that you have bought, is in Myanmar. Can you easily manage your shareholding? Can you do you know what that company is actively doing there? You don't have direct access for that. And it's very hard for you to manage your foreign holdings. You will have holdings in different currencies. So now you have a country risk, equity risk, and now you have a currency risk as well. Okay. Due to these reasons, the foreign shareholders don't really prefer to buy another company's shares which is operating in a different country. Okay. Now to overcome this, now you can see there are issues with both the ends. The business wants to get to the foreign platforms. They want international investors. But international investors are a bit scared to invest in foreign shares. Why? They are unable to manage that foreign holding, and there will be a lot of restrictions when they buy shares outside their country. Okay. Now to resolve this issue, depository receipt as an instrument was introduced. Okay. Now you have a Sri Lankan company here. This company wants to improve their profile. They want some foreign shareholders on their shareholding list. They want to get some international recognition for the company. All is well. Those the intentions are clear for us. But then you have shareholders who, let's see here, they're thinking in dollars. So they are foreign shareholders. They would like to invest in the Sri Lankan company, but we saw they have certain issues. Now, how can you bridge these two intentions? Okay. Now, let's think about it a bit more rationally. So it's very easy for you to see the process of a depository receipt. Now, what was the issue with the investors? The investors didn't have direct control of what's happening in that country. It's hard for them to manage that company's shares because it's coming from a foreign currency as well. Okay. So they would want an instrument which is in their own currency, let's say in dollars. So they could easily trade for. Because if it's rupee, they need to convert the dollar to rupee and there's a currency risk involved. So they would like if that company issue their security in dollar terms. Okay. For that, the company could approach a bank. They would say, look here. And the company would approach the bank and say, look here, there are certain investors in your country who would prefer to buy my shares, but they have these issues. Okay, they are unable to manage their foreign holdings. They are exposed to the currency fluctuations. So will you be able to support me in this endeavor? The overseas depository bank would say, okay, let's see how we could structure it. And they would say, first, you give me a part of shares. You give me part of shares which you would like to allocate for the foreign investors. Okay. So the company would allocate part of their shares. But will that part of that shares again come to the overseas bank here? Now, this is not the bank's name. It's a bank located overseas. Okay. So that company is also located in a foreign country. Again, that bank also will have certain issues. That bank also doesn't have any direct access to this company. They can't hold the shares of this company. Okay. So that bank would say, their bank would call up their local agent or their domestic custodian bank and say, look here, on behalf of us, can you take this particular company's shares into your custody? Okay. So what happens? The company will now give the shares or deposits part of its shares to the domestic custodian bank, which is in Sri Lanka as well. But usually, even though the company is in Sri Lanka, it's an international bank like Deutsche Bank or HSBC or even Standard Chartered. Okay, they would deposit their shares with this custodian bank. Now, let's say this was Standard Chartered. So when Standard Chartered Sri Lanka gets the shares, they would call up and inform the overseas depository bank, say, look here, we got the share deposit. They will acknowledge the share deposit. Now, overseas depository bank can trust their domestic bank. The overseas bank is also, let's say, Standard Chartered UK. Okay, Standard Chartered UK can, of course, believe Standard Chartered Sri Lanka, all part of the same bank. Now, this overseas bank would use the shares as collateral, as backing, and issue new security, which is in the foreign country's currency. Now remember what was the issue with the investors? Investors are unable to manage for their foreign currency holdings because it comes from multiple currencies and stuff. Okay. Now overseas depository bank is now rectifying that. they have the deposit of rupee shares. Backing that rupee shares, they will issue instrument in their local currency, and that is called depository receipt. Okay, they will issue the depository receipt to the foreign investors. Now foreign investors can easily invest in this security. Why? It is in their own currency. Okay, and when they invest in their own currency, that proceeds will go to the overseas depository bank, and then overseas depository bank will remit it to the Sri Lankan company. Will they just direct the entire amount? No. We are all bankers. You and I know we have certain charges. We do all this for fee income. So what do? We deduct the relevant charges, our charges, the domestic custodian bank's charges involved, and then send the money to the Sri Lankan company. So the raised money after deductions for charges is remitted to the Sri Lankan company. It can be a direct remittance, or it could go through the domestic custodian bank as well. Usually it's a direct remittance made. Okay, this is how the flow of a depository receipt works. So this depository receipt is an innovative global finance vehicle, or its instrument. Why is it innovative? It is able to solve a big issue of bridging that local company with the foreign investor. Now, do you know in Sri Lanka, you have certain companies which had issued depository receipt. I think HNB tried in 2004, but it was a bit delayed and it didn't occur actually. But we have one of the renowned companies. The company, anyone would know that company's name, having issued depository receipt in the Luxembourg Stock Exchange. What is that company? John Keel's Holdings. So John Keel's Holdings issued their depository receipt. I think it was way back in 1995, if I'm correct. 1995 they issued this. You could go to their annual report and have a look at it. So here you can see this is the company's number of shares, right? So this amount of shares includes the depository receipts as well. Now, don't stress at the word global at the moment. Just see the term depository receipt. Okay, so they have issued deposit their shares, and backing that depository receipts have been issued now, and they have listed the depository receipt in the Luxembourg Stock Exchange. You and I could view it anytime. So when you type, this is the Luxembourg Stock Exchange. I hope you could see it clearly. Okay. Go to the search bar, type John Keel's. Can you see John Keel's Holdings PLC? Okay. See in what currency is it issued? US dollars. You could see that. And it's a tradable share. So backing. So depending on the local price movements, you could see even here the movement is pretty much the same. You could see a dip coming in, and then the rise until Jan, and then the subsequent fall. Okay. But what's the difference? It's not in rupees here, it's in dollars. Now, these depository receipts can be divided into two. One is global depository receipt, other one is the American depository receipt. How can you divide it into two? The division is very, very simple. If you issue your depository receipt inside the United States of America, then obviously it's the American depository receipt. But if you issue your depository receipt anywhere else in the world other than the US, then it is called the global depository receipt. Now, John Keels, where did they issue the depository receipt? Is it in US? No. So, because they issued the depository receipt outside US, this instrument is called the Global Depository Receipt or GDR. Okay. If it is issued in US, then it becomes ADR. That classification is very, very important. Okay. Now let's see the differences between these two. Now, Global Depository Receipt is also known as the International Depository Receipt. It allows the local company to reach the international platform. Okay. Compared to the ADR, it provides a wider geographical coverage. You could list that depository receipt pretty much anywhere. Okay. But the GDR is often denominated in euros and sometimes in US. So it could use either of the two currency. It can be dollars or it can be in euro. Okay. ADR, it is issued in the United States by a non-US company. It's known, right? The company is from another country. So from a non-US company, a security is issued in the US market. So definitely ADR is issued in US dollars. Okay. So the dividends are in dollars, the price is in dollars. Okay. And the entire trading of ADR happens according to the US trading hours through the US brokers and the dealers. Usual American depository receipt in terms of a global coverage is limited compared to the GDR. And usually several investors use this GDR because it allows them to reach or invest in emerging markets. Important word. The investors in the developed market are able to invest in growing markets, emerging markets, where the growth rates are very, very high. Okay, so they could invest in growing markets and earn their higher income. Okay, that is what the depository receipt means. With that, we are done with equity instrument, and now we are going to move to our stock market. I hope I was clear to you, and if you have any doubts, just let me know. Now, stock market and stock exchange are two different terms. Now, practically, yes, so many students or so many even books sometimes interchange these two words. Even we sometimes refer to our stock exchange as the stock market. Okay. But what is the difference between these two? We know stock market is essentially where the buyers and sellers connect to trade their equity instrument. What is the purpose behind the stock market? To facilitate the exchange of shares. Okay. What is the purpose behind stock exchange? Stock exchange is a platform. It's an infrastructure that allows the buyer and seller to trade. It is a regulated and organized platform so that it allows the investor to trade their shares with the other buyers. Okay, due to this, stock exchange is only a part of the stock market. Now, stock market is the marketplace where the buyer and sellers connect. Okay. Now, if you take stock exchange, it is a infrastructure platform which facilitates this meeting. Okay. So, stock exchange is essential to bring the buyer and seller together at a common marketplace. But it is different from stock market. Okay. So remember, stock exchange is a component of stock market. Okay. Why do we need stock exchanges? Now, stock exchange again is a infrastructure, is a platform that facilitates this buying and selling. Okay. When you have such a platform, it is easy to market the existing security and it provides higher liquidity to the existing securities. What do you mean by liquidity? Because there is already established platform, there will be so many buyers and sellers willing to get into the platform to trade their security. Why? They will have access to a wider market. That platform provides the access to the wider market. Okay. Secondly, pricing of security. Because you have stock exchanges, that the investors are allowed to buy and sell, and these forces of demand and supply help them to price the security, and this allows you to arrive at a value for that company as well. Then you have safety of transaction. All the participants who are involved in a stock exchange are regulated. The seller, the buyer, the broker, the platform operators, the research analyst, every participant is regulated. Okay. And this allows the market, stock market, the participants of the stock exchange to involve in the stock market in a risk-free or in a safer manner within a more organized framework. Okay. Then it contributes to the economic growth by directing investments to productive investments. It promotes economic growth by it. Remember, it gives you that platform. The issuer also has the ability to approach the platform to raise their capital, and through that contribute to the economic growth. Then you have informational efficiency to the investors. Stock exchanges have extensive information on listed companies, and this promotes investors because the disclosures are so high. They know whatever that's happening in a company is communicated via the exchange. Okay. And therefore, there is high level of informational efficiency to the investors. Finally, it provides scope for speculation. But remember, this scope for speculation is monitored, because when speculation is allowed without any monitoring and control, it can be damaging. Okay, it can be highly damaging. So exchanges do provide scope for speculation, but they do monitor it and control to an extent. Okay, what is speculation? For example, this water bottle is 35 rupees. Okay, normal consumption is I pay the 35, buy this water bottle to drink the water. That is for consumption purpose. Business is I buy this bottle 35 rupees for 30 rupees from the manufacturer and sell it to you at 35 at the market price and earn the distribution or income for the distribution I give. Okay. Speculation is I buy a pack of these water bottles knowing that there will be a stock out situation in the market. Okay. I'm speculating, oh, my market will have a stock out situation, and then I could sell these water bottles for double the prices. That is what you call speculation. You buy it solely for the purpose of gaining a higher profit through the price movement. You expect an unwarranted price increase. Now, during coronavirus time, you must have seen internationally there is a huge demand for toilet tissues or tissue papers in general. Okay, so imagine you stocked a bulk of it and you are able to sell it at double the price. You buy it with that particular intention as well. So even in stock exchange, why do they allow this? Because stock exchange, the price, the trading is based on speculation. You need to understand that. Now, let's say there is a company I see, let's say commercial bank. Okay. Commercial bank on Friday is close to 85 rupees. Okay. Now, I buy this company's shares, commercial bank shares. Well, let's say I bought one share at 85. Why am I buying this share at 85? Because in my view, I expect commercial bank to do well. They will report good profits and price of this share will move to 100 rupees. Expecting that in mind, expecting such a price movement or speculating such a price movement, I am buying this share. Okay, so you can see stock market itself or the stock exchange itself operates based on this speculation. Now, this is my view. Okay, I would say the banks have had a bad time during the COVID time. Okay, they gave a lot of moratoriums. Now they are recovering. They are now moving out from the moratorium. A lot of repayment should come to the banks. Okay, so at this stage, they will pick up. The banks will have a turnaround. That is my view. So I am buying at 85 today, thinking that stock will move to 100 in the future. Okay. But if I am buying it for 85, someone is selling at 85, right? Now the seller's view can be, no, it's a high risk time. Bank will have a badder time. Banking industry might have a worse time again. A lot of NPLs might be coming. So better to wash my hand of all the bank shares. Let's sell off commercial at 85 and get out. So that's their point of view. So individual speculation drive this shares prices. Okay. Now, how is this controlled? Is that next week I'll show you the trading platform images for you to see how the buyer and seller put their bids in the share market. Okay. So there you will see there are certain situations, even during last year, you could have seen last year end or even this year beginning, especially, okay, when the stock market had its peak like this. Remember when we had a drastic peak? In this timeline, certain shares within a day had a huge jump. Within a day. Now let's say you bought it at 10 rupees yesterday trade closing. Tomorrow when the market opens, that 10 rupee share would have jumped to 30 rupees. That kind of a jump. Okay. What stock exchanges do is they restrict such price changes. I will explain that to you with a visual next week, so it's easier for you. Not next week, we'll be having another additional class on Thursday from morning 8:30. 8:30 to 10:30 is what I'm expecting. I've informed the institute. So on that day when we do the class, I'll show you an image on how the stock exchange controls this speculation. Okay. Stock exchange provides scope within the provisions of law for speculating in a restricted and controlled manner. So that control I will explain to you. Then we move to listing of securities in a stock exchange. Now you have private companies, right? Sorry. Let's start from the very beginning. You are setting up your own company. Okay. So that is a sole proprietorship. Let's say you are going to bake cakes. You're taking orders, baking cakes. So that's your own venture. You would have put your own money. Let's say you put 2 lakhs from your own salary, collected money, and you have established your shop. Now, day by day, you get a lot of orders. You need a lot of appliances to cater. You might want a lot of material to cater. Okay. So for you to grow, yes, you're getting money, but profit can be a bit less because still you're growing. So you would ask your family to get involved. You might borrow money from your parents and you would say, okay, why not? Let's make it a private company itself. Okay. Let's, have shares of this company between us and, establish a bit so that we'll have certain branches all over as well. So you will gather with your family and collect some additional capital, and you would train certain students under you to run certain branches in other areas. Okay. Now this works out very well. Your branches are now all over the island. There are so many shops established with your name who do this bakery business right now. Along with bakery, now you also sell, let's say, certain products, let's say cake mixers, icing material, some cookery, baking related material as well. So your company has now grown to certain level. Okay. Now you want to move to the next position. Okay. You want to, let's say, go overseas, or you want to establish much more higher branches. Now, a private company which had the shareholding between their own family wants to go public. When they want to go public, they come to the stock exchange. They have to list their shares in the stock exchange so the general public can buy and sell that particular shares, invest in that company, so that the capital will go to the company for the necessary expansion. Okay. So for a private company which is deciding to move to a public quoted company, they would want to list that particular company in the stock exchange to get that additional capital. Okay. Now, can any company get listed in the stock exchange? Now, your bakery company. Okay. Can you directly come to the stock exchange and say, I want to get my shares listed. Let's list it tomorrow. and trade the shares. No. Stock exchange, I told you, is a well-regulated and organized platform. Okay. So they don't allow anyone and anyone to come and get listed. Why? Let's say your bakery company gets listed and there's another company that someone else runs saying X company. Both of them are listed without any analysis. Okay. And X company gets bankrupt. Okay. What happens to the shareholders of that company who invested? They will get demotivated. They would say, oh my God, no, low quality companies or weaker companies are also coming to the exchange to get listed. We have to be careful. We can't trust this market. Okay. So the confidence over the market is hampered. Okay. Due to these reasons, exchanges have listing requirements. Listing requirements, which are the basic requirements that the company should have to list their company in the stock exchange. Why do they have this? To ensure that high quality security gets traded in the market and to safeguard the exchange's reputation with the investors. Okay. So only when you pass those requirements, you're able to list your company's shares in the stock exchange. Now, why do companies want to list their shares in the stock exchange? Mainly to get to raise capital. That's one of the major requirements. Okay, so that is one of the advantages when it comes to listing. If you have listed your company in the stock exchange, you can raise any amount of capital. As long as the investors have the confidence over your company, it's one of the easiest ways for you to raise a huge amount of capital. Okay, so listing in a stock exchange becomes beneficial there. Then, secondly, it helps you to value your company. When you are listed in the stock exchange, the market value of the company is readily available. Other benefit is, if you are a predator company, the company's role or the intention itself is to buy another company and bring that company under your holding. For you to do such takeovers, listed companies is very, very easy. Why? You know the shareholders. You can easily approach the shareholders and ask them to sell the shares. You could collect shares from the market and accumulate, let's say, 50% of the shares to get control over the other company. Okay. Next, you have listed companies having to provide a lot of disclosures on their activity. If you are a listed company, for even the smallest, now there are certain guidelines for which you have to do your disclosure requirements. Okay, when a director changes, when a new managing director comes, when a new chairman comes, when the company is doing certain huge major transaction or major expansions. Okay. Now, these disclosures helps the investor to be aware on what's happening in the company. Okay, they know what's going on in the company, and it promotes confidence of the investors. They know that company can't just do anything on their own. They have to inform to the stock exchange, or they have to put out a news announcement in the stock market. Okay. And this allows the investors to monitor the company as well. They could see what this company doing, where is this company heading. Okay. So by listing in the stock exchange, those benefits are also available. Let me show you some disclosures given by certain companies. So it's easy for you to understand. Now the first page itself, you can see when they have any dealings done by companies. If let's say a director has bought their own shares, they have to announce that. The annual general meeting, when they do a debenture issue, they do a notice as well. Now this is a listed debenture issue, so that's also denoted here. Here you can say a rights issue. No, let's say there is, let's see, for example, a chairman appointment, or you can see when a director resigned, that is also denoted. Rather than, I remember this company when they got one of the biggest let's see, here you can see this is one of their expansions that they were going forward with. So this is in line with one of the disclosure requirements. So the expansion plans are also communicated. I recall when you come to this company, when the chief executive officer resigned, when they have a new chief executive officer being appointed, okay, those are also communicated to the market. So the market is aware, even though you are a shareholder or not, you're aware on what's happening in this company. Now, along with advantages, you also have disadvantages relating to the stock exchange listing. What are those? It's easily, you can see, listing the stock, your stock or your share in the stock exchange is one of the costliest ways to raise money. Remember when we saw the functions in the primary market: origination, underwriting, distribution? There's a lot of time and effort behind that. They need to do a lot of research. They need to price that share properly. They need to get a good managers to the issue to handle it. Okay, so there's a lot of cost involved in listing a company. And secondly, a lot of documentation is required. Now, we saw disclosures as an advantage to the investors, but to the company, they should be aware, even to the smallest thing, they need to make a disclosure to the stock exchange. They need to announce their financial statements on time, not only their annual, even their quarterly financials. Okay, so there's a lot of documentation involved to the company as well. Now here you can see in this particular company itself, there was a recent announcement, okay, where they had a change in their auditor, change in their external auditor. Okay, so when did this change happen? The change happened in 2018, 2019. Okay, but you can see here the company has unable, due to an oversight, has not been able to inform to the stock exchange on this. So now they're making that announcement. Okay, there's a lot of requirements that need to be met with. Then you have increases transparency, which is a good advantage, sure. To whom? To the investor. But to a predator company, is it a good thing? To the predator company, it's a good thing. But that particular company which is making the announcement will become more vulnerable. The predator company is aware about what's happening inside this company. And let's say a competitor, okay, now let's say an expansion such as this made by this cement company. Another cement company could monitor this, could check on this, they might attempt to, surpass this company with another expansion. So the competitor is also aware about what the other company is doing. Okay, so it might cause problems which come from increased transparency. Okay, those are the disadvantages coming from listing in the stock exchange. Now, I told you companies can get listed in the stock exchange, but there are certain ways in which you can list your shares in the stock exchange. There are 4 ways. First one is introduction, then you have private placement, then you have offer for sale, finally offer for subscription. Introduction. Now, just as what the name says, it is one of the very simple ways to get listed in the stock exchange. What happens is, let's say your bakery company as the example. That company, when they were a private company, okay, sole proprietor moving to a private company now. Before moving to a public company, let's say you had 100 shares, okay, you have 100 shares. Through introduction, what do? You get your shares listed in the stock exchange, but you introduce that 100 directly to the market. Okay, you are not issuing any new shares. Simple as that. Whatever shares that you have already issued is introduced to the market. Okay, you are not issuing any additional shares to the market. So it's one of the easiest ways to get listed. You don't have to do a lot of promotions. You don't need the public to invest in your company because you're not issuing new shares, right? If you're not issuing any shares, there is no one to buy that share, which means no any cash inflow. So it's one of the easiest method for a company to get listed in the stock exchange. But be careful, this is a method of listing only. It is not a method of share issue. Why? In here, there is no any shares issue. You're just listing or introducing the existing shares to the market. There is no any cash inflow as well. Okay. So remember that. Secondly, you have private placement. What is private placement? Again, the name itself tells you what it is. You privately approach certain investors and you sell chunks of your shares to that shareholders or to that investors. Okay. Now here it is a method of listing and a method of issue. Okay. But is that issue a public issue? No. It is a private issue. Why? Now again, let's go to the bakery company example. You are in the first introduction, you had 100 shares and you are listing that shares to the stock exchange through introduction. So that entire 100 is now listed. No any additional shares issued. So no one is buying that additional shares as well. So no any cash inflow. Directly your company is listed. Another option that is available for you is you are going to issue new shares. Okay. And your company is now going to get listed in the stock exchange. But when you issue new shares, you might be a bit worried because, okay, not many people know about my company. What if they don't buy my shares? Okay. So what you do is you will issue new shares, but you would say, let's not go public with these shares. Let's approach certain investors that we know and try to sell chunks of your investment, of your shares. Now, already you have 100 shares in issue. Let's say additionally, you're issuing another 100. Okay. For that other 100, let's say you approach some VVIP and say your company is a bakery company, you're planning to do this. You promote your company to that person and you would say, would you like to invest in our company? He would say, okay, let me invest, let me buy 20 shares. So out of the 100, bulk 20 is now gone to one person. Similar to that, you will now identify another party and you will promote to that party. Okay, let's say another VVIP, you approach them privately, personally, and then you would promote your company and you would ask that person, how much would you like to invest? That person would say, okay, let me buy 50 shares. So now 70 shares are sold. For the balance 30, you might approach another two. Okay, so on a private basis, you are selling your new shares to smaller chosen investors. Okay, so here your shares are listed in the stock exchange. You have new shares issued. The company gets new money or company gets equity capital, but the offering that you did is not a public offer. It's a private offer. Okay. Now, usually how it happens is, it's very rare that you see a private placement only. Okay. Usually it is coupled with a public offer. Now, if for example, the bakery company, they might have 100 shares. They're coming to a share issue to get listed. They would opt for a public issue, yes, but they would say, let's not go full 100% public offer. Let's maybe try to sell 70% through private placement and go 30% for the public offering. Why? If the company feels that not many would subscribe for their shares, not many are aware of their company, then they would prefer to couple these two up. Or that is according to awareness. Sometimes they would need to ascertain or certainly identify the cash inflows from this endeavor. They need to guarantee the inflow to the company. Okay. So in that case, when you approach private placement, for sure, you know, this person is buying this amount. This person will do this amount. Okay. That is for sure, it is known. Okay. Due to that reason, you usually couple a public offer and a private placement together. Okay. Now, I think in this example, we saw that as well in the disclosures when we went through. Here you can see NDB, planning to do a rights issue, which is a public issue as well, but it's a bit different. Let's see what that is. And coupling that with a private placement of shares as well. Okay. And then you have offer for sale, offer for subscription. Now, both of these are methods of public offering. You approach the general public to subscribe for your shares in both of them. Okay. Now, when you approach the public, now in the private placement we saw, you approach the investor privately. He's a chosen investor. You would approach them privately, market your company. They would have certain questions. You will inform them what the company is. You will inform them what you do, what you did, who are your competitors, a lot of negotiation and meeting. But when you go to the public offering, can you talk to investors like that with so much of detail all at once? No. So what happens is, when you go for a public offer, usually you issue something called a prospectus. This is the spelling of that. Prospectus. What is this prospectus? It is a document which has entire information about that company. You and I have always seen this. Okay. See, this is the prospectus. In this prospectus, you will see all of these information. Okay. Who are the parties to the issue, corporate information of the company, details of the issue, how are you listing, what is the transfer, what is the cost, how to apply, the details of the company, organizational structure, group structure, the latest shareholder list, the dividend policies and whatnot, corporate governance. So every possible information is available or at the disposal of the general public who are willing to invest. So usually a prospectus is issued when it comes to a public offering. Now that's why I mentioned here, because private placing is combined with a public offer, usually a prospectus is required when it comes to the private placement as well. Okay. Now we saw similarities between these two. Both of them are ways of issuing to the public. In both of them, you will have a prospectus to be issued. Okay. Now we are going to see the difference of this. You can see one is offer for sale. Other one is offer for subscription. What happens in offer for sale is, again, let's take your example, the bakery company. You and your family members. Okay. Now you want to get your company listed in the stock exchange. Okay. What you could do is, you will say, let me sell down my shares. Let's say already you have 100 shares, you hold 20 shares. So you will approach and say, I'm going to sell down 20 shares which is held by me to the general public. And you are invited to subscribe. So the general public will subscribe to the 20 shares that you are selling. Now understand, is that new shares issued? No. Existing shares held by an existing shareholder is sold to the public, but it's not new shares. That is one point. Okay. Secondly, when the public buy that share, okay, they have to pay money, correct? And when they pay the money, will that money go to the shareholder who is selling, or will it go to the company? It will definitely go to the selling shareholder. If you are selling now, you will get that money. The company does not get any new capital. That is important. So offer for sale is also a method of listing in the stock exchange, and they are also a method of issue, but they do not get the raised capital. Okay, the existing shares are issued to the public. Okay, and the selling shareholder gets the money, which is important. Now, this you can say practically, if you take this particular company, VPPL Holdings, What they did was they did an offer for sale. So look at here, invitation to subscribe. They are issuing, inviting the public to subscribe to nearly 30 million shares, which is a existing ordinary voting shares. See the wording? These are existing shares. Those are not new shares. Okay. The issue will constitute an offer for sale, which means somebody else is selling down these existing shares. Now you want to know who is selling these shares. Selling shareholder. Who is selling? The selling shareholder is this company. They are selling their stake and they are using this as an opportunity to get the company listed in the stock exchange. Okay. The objective of the offer is to seek listing on the stock exchange. The company will not raise any funds from this offer. All proceeds from this offer will be credited to the account of the selling shareholder. Okay, that is the way, that is how the capital will get routed, which is important. Then you have offer for subscription. Now it's simple, opposite of these. Offer for subscription is a public offering for which you have to issue a prospectus, but here new securities are issued and the capital raised will go to the company. Okay, remember that. New shares are issued and the raised capital will go to the company. For example, you already have 100 shares. You are issuing an additional 100, but now you are not going for private settlement. You are not privately approaching anyone to sell. You are publicly inviting everyone else to read the prospectus and to subscribe for your shares. And whatever amount that they will sell will come to you. Okay. Let me see whether there is an example for a public issue as well. See, this is an offer for subscription. Sorry. So here you can see this is an offer for subscription. Offer for subscription, here you are offering 120 million shares, which are new ordinary voting shares. Okay. So from this, the proceeds will now go to the company. They have not mentioned that, but it's known because it's new shares and offer for subscription. The amount or the capital collected will be directly credited or given to the company for their endeavors. Now, IPO. What is IPO? Initial public offering. Why a public offering? promoted by a company is because they are able to finance long-term funds by getting a higher capital. Okay, from initial public offering, that method of offering is capable enough to give you a higher quantum of capital. Okay, and it also allows you to identify a price of your company's shares, and it gives you increased independence, especially in terms of finance, where you are now less dependent on bank or credit sources, and now you are able to raise more equity. Okay, and possibility to diversify investments of current company owners by selling stakes in the company in a liquid market. They're able to sell down and realign their shareholders as well. And sometimes companies go for IPO to improve their company name and to improve their transparency level. Now here, when it comes to this BPPL company, you can see benefits of listing the companies in the company share in the stock exchange is to create liquidity, improve the brand name, while also broad basing the ownership of the company. So due to these advantages, the company can approach a public offering, which can be an offer for sale or it can be an offer for subscription. What are the disadvantages of an IPO? Known to you definitely. It has a higher cost. Why? You're going for a public offering. Prospectus charges, underwriter charges, legal charges, analyst charges, a lot of issue related costs. Next, you have a lot of disclosure requirements. You saw the prospectus. You need to develop such a book. A lot of calculation, a lot of write-ups. Okay. Wider dispersed ownership. Now, you saw earlier the selling down shareholder was only one party. Okay. Now that party's shares are sold to the general public. Earlier, there was only one shareholder for that 30 million shares. Now those 30 million shares could have been sold to, let's say, 30 million people. Okay. So there is a wider dispersed ownership, which is given to so many people. That could be a disadvantage as well, because a lot of, then let's imagine your shareholder meetings. Now you have 30 million shares. Let's say one person bought one share. You have about 30 million shareholders. I'm just using it as an example. So imagine your share meeting. A lot of people, because you need to invite all your shareholders. Okay. Segregation of ownership and control, which causes agency problems. Divergence of managers and outside investors' interest, because if there was only 2 or 3 shareholders, they could directly involve in the company. But now let's say you have so many shareholders dispersed all across the country, their interest can be a bit deviated by the managers who have their own interest being put forward. Okay. Information asymmetry problems between new and old shareholders. Now, for example, when the selling down shareholder might have certain information about the company, and that's why they want to get out of that share. Okay. So that might not be aware by the new shareholders who are general public. Okay. So important. Risk of new shareholders focusing on short-term returns. Now, when you issue shares to the general public, they would subscribe to your company shares. What is their expectation? This company will double their profit. The price of this share will double in 6 months. Okay. So what is their focus? The company to earn quick return. Okay. Their focus is on short term. They don't care about what the company is doing in the long run. Okay. So public offering can impact the company in that way as well. Okay. Then you have types of stock issuances and stock transactions. Now, First, we saw method of issuing shares. Now, these are various types of stock issuances that happen in the stock market. You have bonus issue, you have rights issue, share split, stock repurchase, and even mandatory offer. These are various types of stock issuances and even stock related transactions that happen very frequently in our market. Now, if you take our stock exchange, just in the notification section, you saw how many companies went in for. Here you can see how many companies are going for a bonus share. Okay, how many you can see how many entities are going for a rights issue. During the latter end of December to Feb mid, you saw entire Haley's group going for a share split, which was very, very famous. If you had read economic business related news, if you can see all-time high after Haley's group's share splits. Share split was one of the most used transactions or strategies by several companies during the last few months. So those ways you should learn why such things are done by companies and what is the motive behind that. Okay. And then you have stock repurchase. Now, stock repurchase did not happen recently. You should be aware about when companies would use that strategy. Okay, so stock repurchase didn't happen. It was not done recently by many companies. Mandatory offers, yes, when the companies acquire more than 30% of another company, or even a person acquires more than 30% of another company, they need to do a mandatory offer to the other shareholders so that the minority shareholders are not at a disadvantage. Okay. So next week, Thursday, when we meet up, we'll discuss all 5 of these, how these methods work, what is the benefit to the investor, what is the benefit to the company by doing this. Okay, and then we should be able to finish off rest of this topic as well: bull and bear market, short selling, stock symbol, types of orders, which is frequently tested for you all. Okay, that's one of the highest portions that you all have. Stock market indices, and then we would move to the methods of stock valuation. Now, in your syllabus, you don't have to calculate or value the stock through calculation, but you need to know the ways in which you can value the methods. Okay, so we will cover the methods and we should be able to wind up the lecture on Thursday. So again, on Thursday, let's meet up. It's one of the interesting topics because you can see the examples on the practical world live. Okay, so when we'll meet up on Thursday and finish up this topic. Thank you so much for listening. Let's meet again next week. Okay.